Hey everybody, it's Brian Shannon here from alphatrends.net. Today's Saturday, the 15th of August. Let's take a look at this market for the week. We did have a little bit of a gain in the S&P 500, the NASDAQ, and the Russell. The semiconductors continue to be the weakest group. They lost another 1.6%. Oil down again, as were biotechs, the dollar, and bonds. Other markets showed marginal gains. So let's take a look at the charts and make some sense of it. The S&P 500 has just been in this tight range this entire year, and as I pointed out in a chart earlier in the week, the maximum we've been up is just under a 4% gain versus a just about a 4% downward move in the S&P 500, and obviously, that includes this down here. The range since mid-February has really been a lot tighter. Every time we sell off a little bit, it seems as though people are trying to call a top. Every time it rallies a little bit, everyone thinks here we're about to break the range once again. The truth is nobody knows what's next for this market, whether we're building energy for a breakout that will see this market propel to even higher highs, or if this is distribution the market is undergoing, and when it breaks down or breaks out, then we will know. But until then, we're in a range-bound market, and it only makes sense to make the trades from these shorter-term time perspectives. There are reasons for concern, obviously, when we see a leading group like the semiconductors, which are now for the year down 7%, 7.25%, and the group that had been the strongest, the index that had been the strongest, that being the Russell 2000, is only up 0.61% year to date, when it's been leading over the last year or so. So the Russell 2000, we continue to toy with this range that we broke out from of the 2014 highs. That is the prior resistance becoming support. And we do have reasons for concern here, though. We're below this 200-day moving average. And although it's advancing, if you take a look at the way it got to this 200-day moving average, it broke the highs back in June and looked pretty bullish. But from that failed breakout came this fast move lower, a recovery, and then another drive lower. And we're still showing this pattern of lower highs and lower lows. Freeze that picture in your mind for just a moment and look at how the semiconductors have unraveled. They broke out to new highs. They pulled back, rallied, came down to the 200-day moving average, spent a little bit of time below it, similar to the way the Russell 2000 is spending some time below that 200-day moving average right here in this chart. Back to the semiconductors, we see that they continue to bleed off and made new lows this week. And again, we're down 7% year to date. The semiconductors are typically an important group for the NASDAQ. Their underperformance hasn't affected the NASDAQ yet, but we're looking at a 30-minute time frame right now of the semiconductors, and we've seen that this prior support at 53 has acted as resistance. Last week we got up and tested that level again, and of course Monday we backed real hard off of that level. I'm sorry, that we tested it on Monday. This was Tuesday, Wednesday, Thursday, and of course Friday. So now we've got another level of band of support broken that is likely to become resistance. We would need to get it back above 51 and hold above 51 for the semiconductors to become intermediate term neutral. So semiconductors are broken. They are below all these moving averages. Now they are in a downtrend, and to try to predict that where that downtrend ends is just a fool's game. We back to the index, and we'll talk about some individual stocks in a moment. But back to the the SPY rather. The bigger level, of course, is down near this 200 level. So we're about at this point 5% above that bigger important level. So even if we were to pull back down towards 200, it wouldn't do a whole lot of damage to this market. The thing that's of concern really is the fact that this market has gone so long to the upside that you have to wonder if this is distribution. We simply don't know if it's distribution, but it feels that way. Breadth has been losing ground a little bit lately, meaning the advanced decline line. And by the way, on Monday, I've got a free webinar at 6 p.m. Eastern. We're going to talk about current market trends, some individual stocks, and that's something that's available for you to sign up through the link in the email, or we are undergoing site maintenance, actually hosting this weekend. So on Tumblr is where I'll also put that sign up link, and of course on Twitter. But the S&P 500, we're still just in a range, and we are chopping back and forth. I mean, this has been a choppy mess. And if you're getting overly excited or overly scared every time we rally or lose 1 or 2%, there's really no justification for that, because the bigger picture, you have to remember, we're in a range-bound market here. So the NASDAQ, for its part, we have seen that we've been fighting with this level where the market broke resistance back in July. As we blasted up through that level, a pullback is expected, and then it looked like it was going to try to get going once again, but we've lost that ground. We're kind of trying to find support along this 50-day moving average, but it's been showing us a pattern over the last couple weeks of this little downtrend here. So I think for this market to get back to neutral, we need it back up above this little band of resistance right here, basically 111.25 to 112. If we can get up into that, it just turns it kind of neutral and a little bit more positive back above 112. But right now, we've got to continue to be very cautious overall. Back to the Russell 2000, we're guilty till proven innocent. We're in a downtrend. We're going to need to see it back above 121.5 to 122 for it to become more neutral in the intermediate term. That's also where we have that trend line approximately. So this prior band of support tends to act as resistance. If we run up to there, don't get excited, don't chase it. A better scenario would be if it rallies up to that, pulls back, and then breaks higher. Then perhaps we've got a little bit of a attempt at a rally. But with a declining 50-day moving average, I would not expect it to go very far to the upside. So be careful about your long exposure. The financials are just a mess. I don't even want to talk about these things. They're almost as bad as talking about gold was last year, which gold, of course, has been continues to get beat up. But anyways, let's go back to the important things in the market, things like oil. If you take a look at that, what I wanted to talk about here was the fact that you look at these markets and people say, well, it's down too much, and they try to pick bottoms. We had a great rally from 42 up to 60. I mean, that's a big rally percentage-wise. That's a 50% rally, but we gave it all back once we broke that support. If they don't scare you out on the way down, they'll wear you out. And here we saw that oil hit new lows this week. These are 6.5-year lows. And, a lot of times what you do see happen in a market like this is that we undercut that prior low by a little bit and then turn higher. Ask yourself, if you're looking to short this market, for instance, who would short down here after it's just dropped pretty much straight down from 62 to 45? Where has it come from? Second question, where does it have the potential to go where it's likely to find some support? Well, this prior level was some support. We are there. So your risk reward for a short stinks. I think it's also, you look at it, the momentum's lower. So, the odds for a long are also terrible because we're still in a downtrend. Oftentimes we do get a reversal from there that at least provides a little bit of a bounce, but the fact is that this market is very we're seeing stocks trend in both directions. Apple, of course, is a broken stock. It's in a downtrend. It's below all of its important relevant moving averages, including the 200-day moving average. It's going to have to, for the longer term trend is now down. For it to get back to neutral, we're going to need to see it back probably above about 120 to 123. This would be a more neutral band from a longer term perspective. On the intermediate term perspective, we're trying to establish support in here, but there's really no evidence of it yet. We've got a declining 10, 20, and 50-day moving average, finding resistance at that declining 10-day moving average. Apple is in a downtrend. It is not a stock that should be attempted to be purchased in here unless you're looking for very short-term trades. At the same time, you've got a stock like Amazon, which holds on to its huge gains that it's seen. You've got Google in great health, up near all-time highs. So this market is, showing us that trends are persisting despite the overall lackluster performance of the S&P 500. We do have trends that are persisting, uptrends, and then of course downtrends. Buying a stock because you think they're going to get a new CEO is not a good strategy unless it occurs, let's say over here, and then you're buying a stock like Twitter with good news in an uptrend. But news is not good or bad. It's in the market. It's how the market responds. You can't look at it and say, hey, that's good or bad for the stock. It might be good or bad for the company, but we're not trading the company. We're trading the stock, and we're trading the psychology of the participants. If you think that App or Twitter rather is a good purchase because they're getting a new CEO, think about the money, the people who are who've been involved in this from day one. It's in a downtrend. The people that create these big trends are the big money, and they're creating these trends, and they're betting that even if they get a new CEO, it doesn't mean much. If we get rallies in Twitter because of an emotional response to some news, it's not likely to hold. Look at this. I mean, a rally up towards 35 would be great, but we've got a declining 50-day moving average. Keep that in mind. Know your time frame. If you're looking at it from a trading perspective, maybe you get involved if it breaks this resistance up in here. But the primary trend is still lower. Odds do not favor follow through to the upside. Whereas a stock like Facebook holds up beautifully. It's really holding up well in a down market. And then garbage like Alibaba. Who comes public at $68 a share and then announces earnings and the stock goes to 71 and they say they're buying their stock back? They're buying it back for more than what they got from the public. It just seems really weird, this company here. And it's been a huge destroyer of wealth, Alibaba. Anyone who's bought into this stock because it's the Chinese, biggest market, online market, whatever, it's in a downtrend. You've got all this prior support. Support broken tends to act as resistance. It's guilty till proven innocent. Focus on the trends. We'll talk about that in that webinar on Monday, and we'll talk about some individual stock names as well. Meanwhile, I hope you had a good week and enjoy the rest of your weekend. Thanks.